All right, guys. So I am going to be doing a presentation tonight on portfolio allocations. It's a topic that a lot of people aren't very familiar with of how to do it. And I'm going to show you a quick rule of thumb to make it extremely easy. And then we can dive into it a little more. So let's see, presenter view, or no, play from current slide. Start. Okay. So the presentation tonight is it's going to start off with this very simple rule of thumb. And that is, when you look at your portfolio allocation in any type of account, whether that's Roth IRAs, a brokerage account, your child 529, whatever it is, a good rule of thumb to begin with is 120, the number, minus your age. Let's say you're 30 years old, so 120 minus 30 equals 90. 90% should be in stocks, 10% should be in other assets. Now, that is going to drastically shift with different types of accounts. Like, it's a good rule of thumb to use, but like for a 529, for example, you're not going to want to say, hey, you're 30 years old, because it's irrelevant to your child, right? Like if your child's 14 and they're going to go to school at 18 years old and you need that money, to do a number like that wouldn't make a lot of sense. But you can still use this as a base and a guideline for a lot of your accounts. I typically would use this for like a retirement account or a taxable brokerage account. And again, it's a rule of thumb. So I'm 30 myself and I have 0 bonds or 0 other assets besides equities. I'm 100% equities in my portfolio. But it's a good, rule of thumb that you can sit there and say, okay, this is where I might be, maybe not, and when I say other asset, it means other assets in the sense of not just bonds, but it could be real estate, it could be crypto, it could be bonds, it could be real estate. So there's a lot of different things like REITs and stuff like that. And it just depends. And there's no right or wrong answer. Remember that. So I get the question all the time, what should my allocation be? It's impossible to directly answer that without really deep diving into your situation and understanding all the risk factors and, who you are as a person, what type of situation you got going on, all those kind of things at play. But again, a good starting point for this conversation. And like I said, retirement versus non-retirement, which is like, let's say 401k, IRA, maybe a 403b or whatever, the allocations are going to look a lot different based on the goals that you have at hand. So like if you're 30 years old and you have your retirement is not going to be till 65, you have 35 years. So you're not going to like go very heavy in other assets early on. You'll probably be 100% equities. I mean, I'm 29 and that's what I do. And so do a lot of people, right? But for example, let's say you're in a non-retirement account, like a taxable brokerage, and your goal isn't even to hit like a specific number, like maximize that. It's more so to like, hey, in 5 years, I need X amount of dollars. And instead of maximizing, you're trying to preserve the wealth. And so in that case, you're going to be in a different position to where you're not going to take on 100% equities because you have a chance of losing a lot more in a small, 5-year window than you would in a 35-year window. So like, you got to really consider of what the goal of each account is. And I've had, different goal setting. I think I did a goal setting specific presentation you guys can look back at as well on this topic. But that's also a consideration when you guys go to set these portfolio allocations. And then lastly, before I get into some really good detail, I want to talk about the 4% rule, because this is something a lot of times people need to understand is a goal amount. So like when we're talking about goals, and I say goal, and you're like, I don't know what that really truly means. Like a goal for like a house down payment, this stuff doesn't apply. 4% rule makes no sense here, right? But if you're like, hey, I want to retire early, or I want to get to retirement, how much do I actually need? The 4% rule comes into play. So this is where you're going to add up all your investments and withdraw 4% of that total during your first year retirement. In the subsequent years to follow, you adjust the dollar amount you withdraw to account for inflation. So for example, portfolio totals or $1 million, let's say, you would withdraw $40,000 in your first year retirement. And if the cost of living rises 2% that year, this year it's obviously a lot higher with all the recent inflation, you would give yourself a 2% raise the following year, withdrawing $40,800 and so on for the next 30 years. Now, the 4% rule is widely debated. So I'm going to actually pull up my Instagram and let you guys watch a quick video on how I present this today and make sure that you guys fully understand this, because I actually posted this today on the 4% rule, which I think is very, very important. when it comes to it. I'm going to read it. So this is a quick video. The very first thing is we need to understand how much we need for retirement per year on an annual basis. So let's use the 4% rule. What is the 4% rule? This is where you add up your investment portfolio, you times it by 4%, and that's what you're allowed to take out per year. Let's say, for example, you want $100,000 divided by 4%, and you're going to get a number. That's 2.5 million. So your retirement goal would be 2.5 million. So how do we actually plan for retirement? Okay, so that was a little bit of background into the math behind it, but I want to also read kind of the post itself, because this is some good information. Because the 4% rule, like I said, is widely debated. I like it. I think it's a good rule. But if you're conservative, 3.5% or 3% would even be better, because of the period this was actually built upon. So this is, I'm just going to read this post. So we know what it is, you know, how it's a rule of thumb used to determine how much a retiree should withdraw from a retirement account each year. The rule seeks to provide a steady income stream to the retiree or early retiree, while also maintaining an account balance that keeps income flowing through retirement. While I tend to be in favor of the 4% rule, many financial professionals have mixed reviews on it. Some professionals believe you should be even more conservative by using 3.5%, 3%, or even 2%. But whatever side you're on, here's some things to consider. So this was created from a 50 historical data on stock and bond returns from 1926 to 1976. So it's not accounting for when this was like, hey, this is the right thing to do. This is not accounting from 1976 to present day. So a lot of people have some issues with this because of that. Because think about bonds back in the day, you know, when Ray Dalio started his all-weather portfolio that we're going to talk about, he had 55% in bonds. Well, bonds were also at like 12% at that point. So it was a whole different market condition that we were living in. 4% rule helps financial planning and retirees set a portfolio withdrawal rate. And then life expectancy also plays an important role in determining if this rate will be sustainable, as retirees who live longer need their portfolios to last longer, and medical costs and other expenses increase as retirees age. So there's a lot to this 4% rule, but it's a general rule of thumb, at least I think, that you can use to your advantage, you know, from a month to, or from a planning perspective, and think about it like, hey, this is a good start, kind of like the rule of thumb we used up here. This is a great start. It's not everything. You can only get, the more conservative you get, the better. So if you get your portfolio to a specific number that you believe in, and you say, hey, 3% actually lets me live, then you're going to be good. And so you really just calculate your annual expenses. Let's say, like I said in the video, 100,000 is what you're going to be living on. Divide that by the 4%. And you'll get your number. And then you kind of backtrack in order to get to that number. How much do you put on a monthly basis to get there? That's a very important concept as well, to think about. So that was a little bit on the 4% rule. Now I want to get into some example allocations. I'm going to say what I like about them, what I dislike about them, and just general thoughts on them. So this is the traditional 60-40 portfolio. So these are some screenshots out of my book directly. And I talk about these in detail in my book as well, but the 60-40 is the most traditional allocation that you possibly could have. So if you were to go make the 60-40 on your own, you could use these two funds through Vanguard, VFITX, and VFIX was S&P 500. So you're basically doing intermediate term treasury bond or treasury fund investor shares of 40% essentially with bonds, and the S&P 500 for your 60%. Super easy. So what I like about this portfolio is it is low maintenance and you don't have to worry about a lot with this. What I don't like about this portfolio is the bonds are ridiculous. 40% is super high. So depending on where you are in age, you know, somebody that's young or even 50 years old, I would say 50 years old is a cutoff before even considering something like this. But 40% is extremely high, especially in market conditions that we live in today, with the bonds being just awful. But somebody that might be, you know, let's say 60, or they're about to retire, they're 63 and going to retire at 64 or something like that. I don't have necessarily a huge problem with somebody that has a huge bond allocation, simply because the the point of a bond is not necessarily to make you a ton of capital, that huge allocation of capital. It's really to preserve your wealth. And so it's something that you would consider at some point in time. Also, market conditions could change in the future. You just never know. Everyone's bashing bonds because most people on social media are, let's say millennial age, so like 25 to 34 or something like that. And so they see bonds as, obviously they're not good to buy right now, but things could change. There could be a different time in the future that they may make a lot of sense. And especially with your age as well. So that's kind of the 60-40 portfolio. This is the all-weather portfolio. So this is Ray Dalio, famous hedge fund investor and founder of Bridgewater Associates. He created this all-weather portfolio, I want to say back in like 1976, a long, long time ago. And he was built upon his bonds because bonds at that time had a really high allocation. So he looked at, these are the tickers, guys. If you guys want to go recreate any of these, by the way, that's why I put this in the percentage allocation, but it's not necessarily that important. But he had, let's say, the Vanguard total stock market. So only 30% of VTI. This is my favorite personal fund individually, VTI or VT Sachs. I talk about a lot, just the total US stock market, right? What he has heavily in this is bonds and commodities. 40% is 20 plus year bonds and 15% is the 7 to 10 year treasury ETF. And so that's 55% in total. And so his whole purpose of his portfolio is an allocation of risk. And so that's another thing as an investor, when you guys put together your portfolio, most beginner investors will opt to just maximize, go to the moon type thing. Like, what's the best return? How can I get the most for my money type of thing? And that's the thought process. But you got to realize, depending on the purpose of your portfolio, let's say a 529, for example, or where you kind of want to start looking at, your child investing. She's 14 years old. Sorry, guys, it keeps moving on me. I'm going to turn this transition thing off. Apply to all. I thought I did that. Okay, yeah, I think I'm back. Okay, so depending on where you currently are and sitting in your portfolio needs and stuff, you got to be really careful about just going 100% equities and trying to get the best possible big return, because with that comes volatility and downturn. And so sure, over the long term, you probably will make, like, let's say 10% in the market. But if you are your child's 14 years old and you're in the 529, you're like, I need as much money as possible to catch up for, not investing in the past. What a lot of times happens in that 4-year period, the market might take a dip, and you're going to lose a lot more money than you would have if you just stayed consistent with something very more safe, because you're getting closer to that age of 18 years old. Same thing as you retire, you get closer to retirement. At 30 years old, you get 35 years, nothing to worry about. If it goes up, if it goes down, who cares? Shoot for the moon at that point. But when you get closer, you got to start dialing back your risk. You got to change your risk profile. Is going to change naturally, but you got to start to think about those things, because if you don't, you're going to come to the conclusion that, okay, well, I lost all my capital that I've gained over the years, and now I can't make it back. And there's no quick way to make a lot of capital, right? Outside of, running your own business or doing, making income actively. But as far as the market goes, it's hard to just flip profit. And a lot of times when you flip profit like that, if you lose, you have to make more to get it back, which is a really scary thing. So, that's the whole point of this portfolio. I think his biggest downturn was 6%. So think about the 1976 all the way to present day. I think his thing ended in like 08, the little chart I was looking at, but basically his highest was 8%. He averaged 8% return when the market averaged, I think, 10% return. So he was under the market average, but his downswing was only 6%, whereas the market biggest swing was like 40%. So you got to think about the purpose, and that's a lot of times where people go wrong. Now, with that being said, at this point in time, our current climate, I don't like this at all, personally. So 55% in bonds is outrageous, because they're just not, they're not ideal in the market conditions right now. And then this other 15%, so he has it in commodities. He has a commodity index in gold shares, a gold ETF. So 7.5 each, 15% total. So he has 70% in total between bonds and commodities. And that's just that's not something that you're going to want at a young age. And so you got to be very careful when it comes to that. So that's the all-weather portfolio. What I like about it is the purpose behind it, and I think you can model a portfolio somewhat like this with the same purpose, but not the same allocations here. But what I don't like about it is obviously what I've kind of voiced throughout talking about it is like the high bond allocation and stuff. But I do like the 30%. I would like to get that up. So these next couple portfolios are called the lazy portfolios. So if you know nothing about investing and you're like, hey, I just want to get started today, these are your best bet by far, like without question. One, because they're low cost index funds, which you guys all know I love. And historically, this is where long-term wealth is built. Two, they're lazy. So I don't have to do a lot. I can set it automatically and just forget it and not have to worry about this kind of stuff. So the two fund lazy portfolio is what we're going to start off with. And this is kind of thinking back to the 60-40 allocation, pretty similar. Obviously 60-40, and you have the total world stock market and you have the 40% bond market index fund. Now, when I look at the lazy portfolios, my lazy portfolios look different personally. Like I'm right now in my like taxable brokerage account, this is kind of VT Sachs, guys. This is the VTWSX is the indexed or the what do they call it? Institutional shares. When you get to 10,000, it turns to VT Sachs. So these index funds will change, FYI, if you're looking these up. But I'm 70% VT Sachs and I'm 30% international equity. So VTIAX in my brokerage account. So mine's a lazy portfolio, but it doesn't have this bond mix. So this is like the famous two fund lazy portfolio. Mine is a lazy portfolio, but it's not the same mix. So what I like about this is, like I said, you don't have to do anything. It's passive investing. What I dislike about this is the bond allocation. I think it's outrageous. Again, as we've talked about in current climate, I would stay away from that. And then a three fund lazy portfolio. So this takes it one step further. And this adds, as you can see, an international component to it. So VTSMX is the institutional share. VTIAX is the Admiral share class with Vanguard. And all that means is once you guys get past 10,000, they're basically giving it to you for a cheaper cost. Like it goes from like 14 basis points to 4 basis points. So it just changes the ticker symbol. It's the same fund at the end of the day. So they have 40% remains in the bond fund, but 40% here is in the total stock market, which remains the same it drops, from the two fund, and it moves to the 20% into the total international. So what I like about this one in particular is it does add that international component. I love the international component. I think people kind of bash it because of home bias, right? Where most of us are located in the United States. It's the #1 world economy, and we favor the United States economy. But I think a lot of times people forget like that can be detrimental if you don't allocate properly. So the international component is good. With this, the bond, again, I don't like the current bond percentage. But these are actual professional portfolios that are out there in the market that are talked about a lot. These aren't just some random ones I made up. So then we get to the core four, which again adds another fund. So we've now dropped we still stick with the 40% total world right here, but then we go from 20. So we actually up from here to here. We drop this by 20% the bond and put it to 20%, but we allocate that difference 12% more to the international to 32 from 20 to 32. And then we do the REIT on top of that. So the REIT is one of my favorite funds, VG6, or I think it's VGSLX. I think the Admiral share class is. And what I like about the REITs, guys, here is a REIT is a real estate investment trust. So think about owning real estate passively and getting paid a dividend from it. I like this portfolio in a retirement portfolio for REIT purposes because of the dividend income that you'd be taxed on. It's more beneficial from a tax perspective in a retirement account. So I do like that component of it. I'd like that it reduced your allocation to bonds by 20% to 20%. I love the total world. I love this is also VT Wax if you guys are searching it or whatever, the Admiral share class. I love the international component, obviously. And I do like the little bit of REIT exposure here. I think that's a good solid fund to add for somebody. If you look back at like the last top performing asset classes, like sub asset classes, like small cap, mid cap, or whatever, REITs have been the top performer in many years over the last 20 years. So I want to say like 2011 and 2012. If you guys follow Better Wallet, Mark on Instagram, he posted something about that the other day. So good stuff there. But I do like this portfolio probably the best of all of them. The reason being is because you have 72% in equities here and you only have 20% in bonds. I would still, again, I would take that bond allocation probably to zero, ideally in my situation personally as a 29-year-old in a retirement account. I would probably move it all to the total world if I was to have to, kind of rearrange this. I would say 60, 32, and 8 would be fine. And I think that would be a really fine portfolio to use. But again, everyone has a different purpose for their portfolio. They're going to be touching it at different times, age, risk factor, all that kind of risk profile, all that stuff's going to come into play during your, when you're searching for things. So this last portfolio is professional one, and this is actually the greatest of all time, the GOAT, Warren Buffett, right? And this isn't his personal portfolio. So when I say Warren Buffett portfolio, it's not like that's what his Berkshire Hathaway stock is invested or company stock is invested in. He is saying that his heirs to come, he opened a trust fund for them, and he basically did a 90% allocation to S&P 500 and a 10% to FSBSX, which is the short-term treasury index. And this is very telling because not only has Warren Buffett obviously been right many times in the S&P, he's made a bet before on the S&P that would outperform hedge funds. And he's obviously top 3 at the current moment, richest person in the world. And he's relying on this for his heirs. That speaks volumes to how simple the investing game is. The most complicated per se, guy in the world, the top 3 richest guy in the world at one point, number 1, he's going 90% VFX. So in my retirement account, I'm actually 100% VT Saks at the moment. Now I might rearrange that a little bit with some international, but I'm not going to be deviating too much from that. That's totally fine for me, which is the total world or total US stock market, which is basically the S&P plus a little more. And I'm going to keep it that simple. And the reason being, guys, is because a lot of times people think it's got to get really complicated, and the more positions, the better your portfolio is per se. But look at this. It's 2 funds. And look at all these. Like, look back. 4 is the biggest one that, or actually the all-weather has, I think, 5. But yeah, the all-weather has 5. But none of these portfolios, and these are all professional portfolios, have more than 5 positions. So a lot of people want to say, okay, well, this only has 2 positions. Well, what else? What else do I need? And the honest truth is you don't need anything. You don't have to make it complicated, and you can make it really easy. So going back to the beginning where you do the 120 minus your age, it's really that simple. Start off with that as a rule of thumb and work your way into some of these allocations. Obviously, my book talks about some of these as well in detail, and I explain my position as well. I've kind of told you a little bit about, but like thinking across all my accounts, right? So my retirement is VT Saks, 100%, no deviation from that. My taxable brokerage though is 70-30. So it has a different purpose. I'm trying to, I don't need to shoot for the moon with my taxable brokerage as much because it's going to be my early withdrawal or early retirement fund at a younger age. So I want that international exposure to kind of balance out that domestic exposure as well. And to make it very simple, right? I'm keeping it simple. It's 2 funds. But at the same time, I don't want all my eggs in the US because there's been multiple studies, that international is going to outperform over the next decade. But also historically, sometimes international and US, they work inversely. And so like when international's up, domestic might be down. And just to kind of have that, both sides of the equation. But again, I'm even with the home bias, I still think 70% is fair for like VT Saks. On top of that, though, if I look at my HSA looks a little different. So my HSA, I also invest in that, and that is going to be VIIX, which is the large cap growth essentially, and that's more due to limitations, but also because I'm not going to be touching my HSA until 65 at least, based on the reason we use it. So that thing is just going to be sitting there as well, 29 to 65 essentially. And then I'm trying to think of my life. Oh yeah. So my daughter's on the way. She's going to be born in September. So we're going to open a UTMA 529 and a Roth IRA for her. So 3 different accounts. So the Roth IRA is going to be sitting there from 0 essentially to 65 for her. So she's going to be 0 years old, having money put in her retirement account. Absolutely phenomenal, right? I'm going to probably put that 100% VT Sacks, not even touch it, because that's 65 years away that she realistic. Now we might change that by the time she's 18 or whatever, but like in general, she's 65 years away from retirement at birth. And her 529 in UTMA though, she's going to be receiving at 18 years old. So we're going to look at that a lot differently. So there's a few ways to look at this. There's something called a target date fund that you can say, hey, the target date is, 18 years old, 18 years from now. So whatever 18 years would be from now would be what 2021. So 2039 would be 18 years. So you'd probably do like a 2040. So they're coming every 5 years, a target date fund. So you would say like Vanguard target date retirement fund 2040. And we could put that into her 529 essentially, right? And that's one way to approach it. Another way is saying, hey, for the next, she has 18 years, let's do our own target date fund ourselves. And that's what we're going to do personally. So we're going to say, I don't want any cash in her investments. And what target date funds do, they have a little bit of cash, they have bonds, and they have equities. So instead of just, I can easily go to that target date portfolio and see where they're at, but I don't want to be that I guess conservative with my investments, because I'm starting her early. There's the income's okay. So I feel confident with, I don't want to overfund this account. And I also want to make the most bang for my buck while also being reasonable, not just like going crazy or something like that, but being reasonable. And so we're looking at the 529 UTMA is our own allocations. We're probably going to start off with, and I've kind of thought about this, but I'm not 100% positive, is 60% in VT Sacks, always my predominant fund, like by far. Another replacement would be this VFX, 30% international and 10% small cap, a small cap index fund. So we thought about that from maybe 0 to 5 years old. So the first 5 years of those 18 years, we're going to put small cap 10%. Now we might change that, or maybe put even maybe a larger allocation, honestly, maybe 20% or 15% maybe into that small cap fund early on. But as we get closer to her age of withdrawal, essentially at 18 years old or 21 years old, we have to be careful with keeping 20% in small cap or whatever. We have to scale that back and trim that position and maybe move it into a REIT or a real estate investment trust or a bond fund, just because we need the stability. We're not looking for extreme growth. We don't want to lose our money at that point. So maybe at 15 years old, we look a lot different and we kind of scale back to maybe, I don't know, 50% VT Sacks, maybe 20%, 20% VTIAX, and maybe 30% real estate / bond fund. And that could be a realistic thing at maybe 14 or 15 years old, because it's not that we believe in bonds. Maybe at that time they're different, but it's not that we really believe in them, but it's the purpose of the fund or the account is we don't want to lose our money. And so to stabilize that is going to be big at that point. So that's kind of the thought process behind how you allocate these different portfolios based on like different purposes, different risk profiles. Like how do you handle the market? Are you okay with that downturn and all that kind of stuff? So that is my portfolio, or my presentation, guys. Now I want to open up for the next 30 minutes or so on just questions. I'm going to go ahead and look at some of these chat questions here and see. Antonio, looks like you might be questioning some things. Let me know what you're thinking about, because your 2 positions has. Yes. Okay, Ryan, good point. So this is a good comment, I guess you could say. So when we go back to here and we're looking at these positions, right? And we're looking at, there's only 2 funds, or there's only 5 funds in total. One thing I failed to mention was these within have a lot more, right? So if we go to the internet, right, and we just go search, let me pull up VT Sacks, if I can move this chat thing. Okay. So if I go look up at VT Sacks, this is going to have 3,600 positions, I believe it is, within. So you actually own like 3,600 stocks. Like it's not like you own like one necessarily. So 3791. So look at your number of stocks here, 3791. So by owning that, you essentially own 3,700, 3,800 stocks. And so when I say, keep it simple, that's why the game has become so easy with how we can allocate these things, because we're looking at it from a perspective of, hey, we see two, but what I'm really seeing is, okay, for example, VT, this is the VT wax. This is a world. This is even bigger. Watch this. So I'm going to do, that's 8,600. I know that from just memorization. So this one's 8,600 stocks right here, this bottom one. I don't remember this top one. I'm going to search that one. So VBLAX actually is the Admiral share class. Let's see. So if I search this and I go to VBLAX, this is the one I actually did in my book, guys. If you guys read that, 2741 bonds. So you have 8,600 stocks in 2,700 bonds, 10,000 positions in this so-called two-fund portfolio. So that's what I mean is when you keep it simple, because the index funds, mutual funds and stuff like that out there right now have made the game a lot easier. You don't have to go select individual stocks and make sure they hit and all that kind of stuff. That's not what long-term investing has become. It's really automation, putting that, consistent, let's say 15% into these funds or whatever for retirement, whatever you want to contribute for non-retirement, and then just letting it do its work, not thinking about it, just setting it and forgetting it. Maybe reallocating every year, and making sure that your allocations, your 60/40s aren't out of whack, because those things, the bond market and the world stock market might go in different directions, and you might end up with a 70/30. So you might need to reallocate at the end of each year. But I'd say that at the end of each year is plenty. I wouldn't say anything any more often than that would be fine for reallocation purposes. And then maybe every once in a while, like I was saying with the 529, is possibly reallocate or add a position, or trim one down and move it to another based on the timing of the when you're trying to pull that money, stuff like that. But yeah, that's a good comment, Ryan, about the hundreds of positions. And all of these are the same, guys. All of these have, the international I think has like 3,600 or something like that, maybe, if I remember. It might be more, I don't even remember. But I think those are all the questions in the box, guys. You guys can just call out whenever for questions. Yeah, if I'm looking at this has 7,500. So yeah, a ton. And you guys can see, like, this is the top 10 hole. This is the fact sheet essentially of it. I always look at this. I've done presentations on this specifically, but this is something good to look at as well. Antonio, it looks like you're in amazement by that. That should be, I hope that's a good amazement. Yeah, man. I agree. These are gems, and this is something that just isn't, like I said in the beginning, guys, this stuff is actually really easy. It does not take a genius to realize, hey, you're going to own the international stock market, or you're going to own the United States stock market. Like, you don't have to know everything about every company. If I go down here and I look at these companies, like, I know what Samsung is, right? I know what they do. TVs, phones, all that kind of stuff. I know Alibaba does. I know what Nestle does, and all these kind of companies, Toyota, like, we know what they do in general, but we don't have to go search their 10K and do an analysis on them and understand fully of what they do and where they currently sit, because you have so many guys in this that you don't have to worry about if they're up or down in the short term or whatnot, because if one of these guys are down, somebody else is up. So there's a lot of help from having a huge group versus just one of these guys. Do you have a calculation you use to start moving away from stocks and going to bonds? And I think the rule I read was 110 minus your age should be your percentage allocations to stocks. Yeah. Ryan, good question. So that was the first slide on here. 120 minus your age. So another thing, guys, to this is Some people use 100 minus your age. I think that's way too conservative. Some people do use 110. I think that's fair, but I would use 120. So yeah, Ryan, you were watching the game. That's what you were doing. Um, so honestly, like when you are doing this, guys, you guys can technically, there's a lot of rules of thumb. This is my rule of thumb that I've kind of, and it's also professional supported, but like, I think 120 is plenty fine for, especially in the market that we live in today. So I think it's fair. 120, I've read that. Yep. Um, Ryan, what's the latest on the game, by the way? Give me the update. What's a good management expense ratio? I would say 0.2 and lower. So if you guys go back to here and you guys go up to the expense ratio, that's what they're referring to, management expense ratio often, so MER, 0.11. So this is 11 basis points, 1/100th of a point. So 0.2, 20 basis points, I would never go higher. So if you go, and this is the controversial thing right here, and a lot of people in Wealth Squad are in this fund. So if you guys go to ARC, and you guys look at this expense ratio, you're going to see 0.75. I just want to show you from, so right here, expense ratio 0.75. So that's why I don't like ARC personally. Nothing against Kathy Wood or whatever, but 0.75 is way too high for me. That's, 55 basis points above what I would even go to at the max. That's a big difference. Fees eat up a lot, so you got to be very careful with those, and that's primarily why I don't like ARC and stuff, any actively managed mutual funds. The reason why this is, like I said, Kathy Wood, so she's actively right here actively managing this fund, so she's buying and selling stocks left and right to keep this fund in line with what she wants. Whereas something like this, guys, is a low cost index fund. So when I say low cost, it means expense ratio, and the index fund is index, as you see here, it's tracking an index, so they don't really have a fund manager buying and selling, right? It's very, very passive, and they don't really do much on their end. So that's why it's the difference in cost. The Bucks are up, man. The Bucks got pressure on them. Not to get off topic, but they flopped that series though. The Tigers, man. I'm an Indians fan, so the Tigers suck. ARC, I see why. Must be because of unrefined ARC. Yeah, it's more the actively managed piece of it, man. Like, there's a ton of different actively managed funds that are, let's say 0.75 or higher, because they're actively managed. They got to pay the people involved with it, right? There's a lot of analysis going into that kind of stuff. Did I hear that right? I can start a Roth IRA for my child. Will this count against her financial aid when applying for college? The IRA, yes, you can do for the child. So this is the thing about a child Roth IRA. So with the Roth IRA, you gotta have earned income. So when your kid's like 1 year old, it's really hard to get earned income with that. Like, hold on. So when you have, so this is what we're doing, right? We have our daughter's coming in September. She's gonna be 0 years old. I'm gonna actually employ her under my LLC and baby model and pay her a salary, right? That is not practical for a lot of people. Most people aren't gonna own their own LLC, and most people aren't gonna have a kid that they're gonna take pictures and give baby modeling. Like, it wouldn't make sense with the LLC, right? But it makes sense with what I'm doing, because I might do baby merch or something like that. So it actually makes sense, and I can pay her a reasonable wage. Now, obviously, she's gonna be laying there on the ground. I'm gonna be taking pictures of her. So I can't be paying her $6,000 a year to do that, which is the max of the IRA. But I can go to a reasonable general, I don't know, I could literally Google what's the average baby model get paid, right? Average baby model. And this is what the IRS is going to look at. They're going to say, okay, you did how many hours? 25 hourly rates, 25 to 75 an hour. If a baby scores a super gig, they may receive 125. Well, my baby's not going to be a super gig. She didn't land a gig. It was her dad that let her do this, right? So she's going to probably be, let's say $50 an hour. So if we take pictures for an hour, I'll give her $50 technically, right? I'll pay her. That $50 is going to be taxed. Like, she's going to have to file taxes, earned income, right? And then I'm going to put that into her IRA. And so that is a very, very rare thing that a lot of people can do. But as your kid does get older and more competent, let's say 10 years old, and they're shoveling grass, or let's say cutting or not shoveling grass, um, shoveling snow or cutting grass, they might make some money, right? So if you guys get paid under the table, like from a neighbor or something like that, if you record that income and pay taxes on it, then you can do the Roth IRA. And so that's what I would recommend. I think you should pay taxes on it because honestly, you're going to be paying the taxes ultimately, right? And paying your child's taxes are going to be minimal because the money is not going to be crazy. At the most, it's going to be $6,000 if you maxed it out. But also you're putting money away in an investment account as a Roth IRA for the retirement, starting at, let's say 10 years old or something like that. Also, when they're 16 years old, it's a lot easier, even because at that point they're actually making legitimate income. So they might work a restaurant job or something like that. Like I worked at the old Mickey D's at 16 years old, right? I worked at Skyline from the Cincinnati area. So I worked at all these restaurants. I did landscaping, I did construction, I did all these kind of outdoor, side gigs. I was getting paid from my from the construction job under the table, like a lot of people do. But if I would have known this at 16, 17 years old to file taxes on that, under the table income, and then go ahead and put that in a Roth IRA at that age, my retirement would be 10 times further than it is right now. And so it's something I wish I would have known, but at least I'm going to make up for that with my daughter and say, okay, I didn't know that, but I'm going to try to start doing that going forward. As far as applying for college, it does not count against college. So financial aid, FAFSA, and stuff like that, it will not account it would not count against her. Oh crap, we have more Tiger fans in here. It looks like Amanda's a Tiger fan. Man, are you guys all from Detroit? Looking at my 401k now, 0.09 good. Yeah, 0.09 is pretty solid. I wouldn't be mad about that. Like I said, I have this fund and that's 0.11. So 0.11 and 0.04 in VT Sacks is what I have as well. So based on my allocation of split, it's like 0.06. See a 0.04 here. That's essentially what I have in total. Holy crap, you guys have all these freaking Detroit people, man. I'm from Cincinnati, like Northern Kentucky area, but my dad's from Cleveland area. So I'm a big Cleveland fan. Browns, Indians, Cavs, everybody. Do you guys have other questions outside of these that I missed or anything? Does Detroit, Texas count? No, it does not count. I'm shaking my head, Cincinnati. That's why I say I don't like Cincinnati that much. It's all right. I lived in Cincy though for a bit, and Skyline and has nothing on Coney. Oh, Skyline is the bomb. I had Skyline this weekend. I eat it too much. It's my favorite restaurant. It's amazing. And don't bash my Skyline. Gold Star second tier to Skyline. Since you're from Cincinnati, you understand. It's me, Gullah. Oh shit. What's up, Gullah? I'll definitely be reallocating my assets throughout these more frequently. Are these tradable in most brokerages? Yeah, you can swap around. So okay, so retirement. I recently did this with my retirement account. There's no penalties or anything. You can just swap them, right? Because you don't have that capital gain aspect that you would have in a taxable brokerage account. So for a taxable brokerage account, guys, if you guys are reallocating at any given point in time, instead of like selling, so you could do like, okay, if let's say go back to this PowerPoint and you see this goes to 70 and this goes to 30, and you're like, hey, I want to get back to 60-40. So you want to sell off 10% and buy here. So by doing that, you're going to recognize a capital gain. So you won't want to do that. So what you would want to do instead of doing a 60-40 going forward, future contribution, maybe do reverse and do like 50-50 or something like that. So to kind of reverse the course of it. So you're never going to be perfect. It's never going to stay 60-40. The only allocation is going to stay consistent is 100-0. You're always going to have some slight variation because either let's say the S&P outperforms the bond here like significantly, you'll jump up to 70 or something like that. It's okay. I wouldn't get overly worried about that. But I'd say like going forward, maybe change your allocations to kind of get back to that 70-30 in a taxable brokerage because you wouldn't want to sell and then get hit with capital gains tax. That would not be the wisest decision. But with retirement accounts, you can do that without penalty. Go. I need to follow you on Instagram. My 401k is 10% and split in 3 bond accounts, but I plan to retire in 16 years. I think this is okay. Would you change it? I'm trying to think. So if you retire early in 16 years, you probably still have a retirement account, I take it. So if you still have that retirement account, you don't necessarily need to worry about like and when you say 3 bond, what's the percent or 10% split? Okay. I think 10% is fine. I don't, I wouldn't overreact to that by any means. But I wouldn't make this as conservative as your retirement when you get close to it. So like an early retirement is kind of a luxury. So you still want to early retire. You don't want to screw that up or anything. But like if let's say the market takes a hit a little bit, like, and you lose a little bit of your income or your balance, it's not the end of the world to wait a few years in early retirement because you're way too bond heavy and you're not making anything, and you sacrifice that because most chances are you'll be fine. So it just depends on your risk tolerance and comfortability with that. But I think 10% is fine. I want to get over the top about that. One other thing, guys, I want to show you. So I have Chris's stock market gems up. So this is a presentation I did last week or 2 weeks ago, whatever, when I did a risk profile quiz. So back up in the Wealth Squad University with the last one I presented on, I actually added this PDF for you guys. If you guys did not make my last presentation, go through this. This is a really good tool to use. And it walks you through everything here and like has you fill out different questions and stuff based on your risk profile. And then based on that, it's actually going to shoot you out a decent portfolio down here. So you're going to fall within one of these ranges, right? Like based on your score. And then down here, it's going to say what kind of allocations you're looking at. So like it actually has like a cool little allocation thing here. So if I were you guys, I would go use this resource. It's posted in Wealth Squad University, I believe, under the last presentation. I think it's going to really help. I think a lot of people took a lot of value from this because it walks you through a very detailed process. And as you can see, like a lot of times with like retirement accounts, they'll say like, what's the investment strategy? And you'll just select one of these and essentially that it would automate to one of these guys for you and do it all on your own. But I think understanding where you lie and then maybe critiquing it to you yourself is really a good idea. So I'm not going to jump too much into this piece. It's in my last presentation where I walked through this entire questionnaire thing, but it's a good tool and it's in Wealth Squad University for you guys to use. I got to hide Chris's stock market gems. I'm going to give all his secrets away. Any other questions, guys? Obviously, this is open Q&A, so you guys, any questions that you have, just shared it in dividends chat. Okay, perfect. Good stuff. Awesome. Appreciate it. Yeah, guys. I mean, I love doing this stuff. I like talking to different topics. Next one is I'm going to be talking on budgeting and stuff, but Wealth Squad University is just that place is just crazy with knowledge. So to go back there, even after these presentations and rehash, and you even rewatch one of the videos to see if you missed anything, is always really good to do. I think that there's so much knowledge in that Wealth Squad University. It's bar none. I don't think you can beat it anywhere. It's basically the personal finance or Netflix personal finance is how I call it. And there's just countless knowledge in there that if you spent 30 minutes a day just going through those videos, you're going to be 10 times more ahead in 6 months, literally, if you just spent 30 minutes in these videos. Sometimes the chats can get really fast. So watching a video at your own pace and stuff like that is a really good thing to do. All my stuff's in there. If you ever want to watch mine personally, you can figure out who's doing it, which topic and everything, obviously. Good stuff. Good place to be. Appreciate all the comments, guys. Yeah, Wealth Squad University. If there's no more questions, guys, we have like 10 more minutes. If you guys want to ask any question for anything, it's all up to you guys. It doesn't have to be specifically allocations. You guys can even ask me what my favorite color is. I don't care. But if not, I'm not going to hold you guys here. So I appreciate it, guys. For anybody that doesn't know who I am, I didn't do an intro in this one like I usually do. I'm I'm going to type it in here. It's as simple as that. My Instagram is BudgetDog. My Twitter is BudgetDog, and my Facebook and my newborn TikTok, which is a work in progress, but it's there. Everything's there. Connect with me on all those accounts, guys. DM me. I get back to all the DMs. I've never not responded to a DM. So, oh, got you, Frank. Hold on. Two fun lazy portfolio was the total bond and total world stock market. So VT Wax and VBMFX, 60-40 split. But like I said, I think 40% is way too high on that specific one. I would never go 40% bonds at my current age, but good stuff to know though, at least at some point in time, who knows where bonds end up. Yeah, Mike, exactly. That's a good comment. The more you guys learn, the more education, the more confident you're going to become, which in turn, the more conviction you're going to have. That's why I'm so so focused on index funds, is because all the information I've studied on in the investing game, index funds, low cost index funds are the premier way to go, in my opinion. And yeah, somebody raised their hand. I think I saw it. I don't know how to check that though. If you guys raise your hand, you guys can call out. Okay, maybe not. M1, I'm assuming you're asking about, like, is that a good platform to use? That's an excellent platform to use. I think Vanguard, Fidelity, Charles Schwab, M1, E-Trade, or TD Ameritrade are all good platforms to use that I would fully support, depending on where you what you're trying to do, obviously between the trading and investing, but like all of those are good for those two reasons. Where can people find me in the Wealth Squad channels? I pop around. I mean, you can always tag me, guys. If you guys do the ad, you can always tag me in the ad, and you just type in BudgetDog, you'll find me. If you want to ask me a question, but I'm also I hop around to quite a few. I'm in personal finance, I'm in student loans, I'm in tax, I'm in the credit chats, I'm in index funds, I'm in dividends, I'm in the stock chats, the main chat, which is called chat, the support, and the other one there, I forget what it is. I kind of hop around to quite a few. I'm in the crypto as well. I mean, I'm all over the place. So just tag me if you need to. Have I ever tried Webull? Tiara, I have not tried Webull. I'm not against Webull because I've heard a lot of good things about it. I just have never looked into it. But I wouldn't necessarily not recommend it. I just don't want to put my backing on something I haven't actually experienced. Can you buy Vanguard funds in another account like Fidelity or TD or Ameritrade? Yes, you can, but you got to sometimes be careful with that, because if you go to Fidelity and go buy one of these funds, guys, that's a good question here. So if I go to Fidelity and I have Fidelity, and I'm like, okay, I watched this presentation, I want to go recreate, let's say, the core 4 lazy portfolio, and I go search these funds, they might pop up, they will pop up, but you'll probably get charged a $75 fee. So to check the equivalent. So for example, if I'm going to go search Fidelity and I'm like, okay, I want the total international index fund, right? Instead of going to use VTIAX, do VTIAX Fidelity equivalent, and you're going to find FSIVX, right? I think that's the one. I thought it was FSPSX, actually, to be honest. International index fund. This is the one I like. You're going to find their equivalent essentially. And then you just want to buy that one within that specific broker, because then you won't be charged at like $75 upfront fee, and it's going to save you on fees, but it's the same like core holdings. Like FZ Rocks, for example, like that would be the Fidelity equivalent of the total market one, right? So FZ Rocks, it's also a little cheaper at 0%. It's free. From a expense ratio standpoint, not overall account fee, but yeah, 0%. So that's something good to know. Discord newbie. Yes, that's the other chat I'm in a lot. Correct. But Gully, you hold that one down, man. Webull is structured on Freedom. They're nice, not as nice as TD though. Yeah, TD. I actually have TD. I have it on my computer actually. I use it as a kind of a where's that? It might be my other computer actually. TD Ameritrade. I had it here at one point. I have it on my other computer, but I have it for my practice trade account. So I don't trade or anything, but I'm starting to learn, obviously, as I have Chris's cyber money deal right here that I just got. So I'm trying to get into it, and I use TD Ameritrade for that. Capital gains would have clapped my expenses. Yeah, capital gains, guys, they're nothing to play with. You got to understand capital gains, especially short term. Anybody trading is going to be getting hit with a short term capital gains. So just understand that. When he gets into trading, he would dabble into Robinhood, Webull, and TD. I will stick with TD Ameritrade when I get into trading at all. Again, I'm going to stay predominantly index funds, guys, but I am going to. I like to challenge myself and learn new things. So even if I don't like to do it, I want to learn it to make sure I understand it. That's the key there. And I'm going to stick with TD Ameritrade. Robinhood scares me. Webull, I don't have much experience with it. I think I'm pretty comfortable with TD. Using FC rocks for my dollars Roth since I have Fidelity. Amazing. That's exactly the same thing I'm doing for my dollars Roth, which would be VT Sachs. I bought some VT on Fidelity, didn't realize there were fees. I'm not sure I actually got charged or there was a fee for it. There might not be, it depends. It's kind of select, but typically if you buy a Vanguard, because think about it from their perspective, guys, is like if Fidelity is housing of a Vanguard fund, they're going to have to make money somehow, right? So that's typically where they get you in that first initial transaction cost. I'm not saying every fee or every fund has that. Like if you use like TD Ameritrade for something and you buy VU or something, I don't think you're not going to get charged on that. I don't think. But just be careful. Like it should be explicitly stated if you're going to get charged before you purchase. Just be aware of that when you go to hit that purchase button. What's this I hear about Chase Sapphire? Okay, so I'm not the credit expert, and I'm also not a credit type of guy. If you guys follow my Twitter, you guys saw today I'm paying down my house, and like I'm very against like debt, credit, all that kind of stuff. But somebody was asking me about what's a good travel credit card, and so that's what I said about. I think that's what you're probably getting at is the Chase Sapphire. So Chase Sapphire card is one of the best ones out there that I've heard of. But again, I don't have this and I'm not necessarily planning on it, but they have this $100,000 bonus right here, which is technically their best thing ever. And that's what's kind of driving a lot of people to it. But again, you have to spend $4,000 on purchases in the first 3 months, which I always make an argument is like, I probably wouldn't do that. So I want to get those bonus points anyway, blah, blah, blah. That's another day. I should do a presentation on credit and why I hate credit, but if you guys follow me, you probably understand my stance on it though. All right, guys, if there's no more questions, I'm going to get off. It's about 9:30 now. Okay, hold on. What about if you're transferring to another brokerage, but already have a mutual fund purchase, for example, I'm considering moving from Vanguard to Merrill Lynch, which don't have their own funds. You should be fine, but talk to both brokers. So obviously talk to Merrill Lynch who you're moving to, and then talk to Vanguard as well. Just call their customer service line and make sure during that transaction that you're not getting fees or anything, transaction fees associated with it. Typically, if you're moving from like broker to broker, you should be fine and there shouldn't be fees. But I did hear, and I thought that, but then today somebody mentioned that they were transferring, I believe, from Robinhood to one of the big, I think Fidelity maybe, and they were actually, Robinhood might have been charging the fees. I think it was Robinhood or Webull maybe. They were charging their fees. So you got to be careful with that. But just call customer service, you should be fine. Brick and mortar seems better than an online broker. Maybe, yeah. I mean, Vanguard, Fidelity, those guys are good. Happy taco. I need a taco right now. Come make me some tacos, Antonio. All right, guys. I appreciate everything. I don't even remember what I had for dinner, actually. I'm trying to remember. I'm getting way off topic tonight. I'm usually a lot more focused. All right, guys, appreciate everything. Hit me up on BudgetDog, at me if you guys have any questions, DM me. Again, I appreciate all your guys' time as always. You guys mean the world to me. So thank you for everything you guys do, and I will talk to you guys soon.